Good? Okay. Hi, everybody. My name is Jason Jones. I'm one of the partners at Disruption Credit. Welcome to the Big Data panel. And I apologize for that atrocious picture of me. I don't know, it's like I'm glowing or something in that picture. I don't know what happened there. But happy to have you guys here. This panel is, we've listened to a lot of the different online lending platforms and their different strategies kind of around the world. And with this panel, we wanted to really explore the data behind the panels and how that data is being used to enhance the credit underwriting skills of the platforms and the banks as well. So, again, this is happening on a global basis. So we put together this panel of really interesting companies that are taking a data approach to their business. We have Mark Hookey, the CEO and founder of Demas Data, Mike Mandelli, the CEO of L2C, Catherine Petralia, the co-founder and COO of Cabbage, and Jeff Stewart, the CEO and founder of Lendo. So let's start with Catherine. Welcome. Thank you for coming. You know what? Actually, I'd like to start with the panel, and I'd like you to just go down the aisle and talk about your client. We have two platforms here. We have two data providers here. So if each of you could kind of introduce yourselves and tell the audience who your client actually is and what type of business you're actually operating. So I guess, Jeff, you can start.
Sure. So Lendo helps people in the emerging market middle class prove their identity and trustworthiness so that they can access financial services. Basically, what we've done is we've built a social microfinance-like lending platform that's integrated with Facebook, LinkedIn, Twitter, Google, Yahoo, and that allows people to show that they're trustworthy in their community and then get preferred access to financial products. Today, most of those financial products are offered from us.
I'm Mike Mandelli with L2C. We are an alternative data credit bureau. So we're a data and analytics company. Our primary customers are those clients doing lending in the form of auto loans, credit card, or unsecured loans. And typically they're focused on a sub 740 FICO range or a consumer that is relatively new to credit or has a relatively thin file at a traditional credit bureau. So what we do is we provide a suite of scores and attributes out to those lenders to help them make better acquisition and underwriting decisions on that consumer segment.
Hello everyone, Mark Hookey of Demas Data. Nice aspects of both Jeff and Mike's businesses there in terms of what we do. So we're a data and analytics company as well. Our clients are banks and online lenders and peer-to-peer lenders who are making assessments about customers and pre-screen decisions about customers. We provide back-end analytical technology which aggregates largely people's online footprints. So their engagement with social networks, small businesses' footprint online, and a whole bunch of other data sources.
Catherine Petralia with Cabbage. Our customer is a small business looking for access to capital that they can use to grow their business, and we've built a data and technology platform that takes advantage of alternative real-time data that we use to build a picture of that business and deliver capital to them instantly through the use of real-time verified third-party data sources that we get on an ongoing basis. I know you might have heard us talk about fingerprint underwriting, but the idea is to build a unique picture of every customer and tailor the offer and tailor the product that serves their needs.
Great. Catherine, let's stick with you for a second. You describe yourselves as a data technology company when you are also a small business lender. Can you explain why you position yourselves in that manner, and maybe just go into some details there?
I think we were born out of data. We started the company because my partner and our CEO, Rob, was working with some eBay data. So eBay launched the first public API in 2006, and they did it because their site was slow because people were crawling it and scraping data. And he said, well, wouldn't it be really interesting if you could use that data for something else, like maybe to assess the risk of a small business owner? So we started with the data, and we said, what could you do with the data, and how would you use it, and what kind of a product would you create out of that data? Over time, we've added many more data sources. But the idea is today we're proving out the data and the value of the data, the relevance of the data by providing capital to our customers and seeing if it works to determine who's more likely to pay you back. So in many ways, I would say the lending business, the funding business is a proof of concept for the data and technology business.
Jeff, maybe you could tell us a little bit about your business, how you started it, and what your market is.
Sure. So we got into this because we had started other companies. We had employees in the emerging markets, very hard workers, very employable, couldn't access credit. So as we dug into it, we realized that this was a problem for about 1.2 billion people moving into the emerging market middle class who are underbanked. And we figured we could solve this or make a difference, and then we stumbled upon microfinance. And it's about $50 billion a year is deployed using this sort of social lending technique. We realized if it works offline, it should also work online. You don't have internet friends, you have real friends. And luckily, we had started a big data company before, and we realized that we could use that social data to understand really the human dynamics of how groups work and how to extract trust from how you interact with your community. So at the end of the day, we're a bunch of mathematicians looking at the anthropology of how trust is communicated within a community, and we use that to administer credit. We send money to people we've never met over the internet, and they send it back with interest.
Can you go into a little bit more detail on the Lendo score, what that is, how it works?
Sure. So the Lendo score is it's really a trustworthiness score. It's a reflection of your community and how your community behaves and the strength of those connections. Of course, your repayment behavior affects that, but also the repayment behavior of your immediate connections in Facebook, LinkedIn, other social connections. But even further out, on the internet, everyone is connected, generally by about 4 hops. So as we add more members to our service, we're able to calculate how they're connected back to good borrowers and bad borrowers, and from that, we're able to manage risk in an extremely efficient manner.
I think the community aspect of what you're talking about is very relevant and very interesting. Mark, I'd love to get your thoughts. You're also focused on some of the similar markets to Jeff. Talk about layering on social and some of the data sources that you would use to verify somebody that may not may have a cell phone and may not even have an address.
Yeah, so I mean, this is a question we get asked by banks and bureaus in emerging markets. There are, as you say, Jason, there are people whose registered address on the application might be something like second on the left past the 7-Eleven, but they're walking around with a mobile phone and they've got a Facebook account. The disconnect between the more traditional data sources, like the credit bureau data sources, and the online penetration is enormous, especially in emerging markets. It's enormous here in the States as well. A lot of the people we've heard from today, the alternative financial service providers and the peer-to-peer platforms, exist because the customers on these platforms are not bad applicants. They're misclassified by the more mainstream banking system. So social is one of many ways that you can bring data in to help classify these folks with more accuracy. And depending on what country you're in, that means different things. But the social media data is one of the best sources of a deep profile about who someone is. So ask yourselves 5 years from now, what do you care about more, your Experian credit report or your LinkedIn profile? I already care about my LinkedIn profile a lot more than my credit report. In fact, I got rejected by Chase for a credit card just a few days ago. The credit report is too backwards looking. It exists and serves a great function for legacy reasons, but the depth of data that's online creates a 360 profile of the customer that in our experience is very powerful.
Great. And Mike, Mark just brought up a great point there about credit bureau data versus LinkedIn. What's your thoughts on FICO, and what does L2C do in relation to FICO?
Sure. So I think Mark's onto a number of interesting things. What I would say about FICO, we started the company in 2000, and really we've seen tremendous traction since 2009. And the primary reason we saw tremendous traction since 2009 is because FICO and credit bureau data in general was basically revealed as being backward looking. The credit bureau data is good if you have a very stable, well-established consumer and you really want to know what the liability side of their balance sheet looks like. If you're interested in the asset side of the balance sheet or what their income statement looks like, it does you no good. And if the macroeconomic environment changes, as we saw in 2008, 2009, 2010, it's very slow to react. So what we do is we really focus on filling those holes with the income statement type data, so checking account performance, short-term payday loan performance, do they take them out, do they pay them back, those types of things. And then we supplement those with asset data. And so we set our sights on a specific segment of the population, and I talked about it earlier. You know, between 550 and 750 on the FICO scale, 42% of the U.S. population falls. So it's about 82 million or so people. If you then look at those people that have 3 or fewer trades at the credit bureau or that have no data that can be scored or do not show up at the bureau at all, it's about another 88 million people. So you're looking at a sizable segment of the population when you put those two groups together. That's where credit bureau data becomes either very homogeneous or it's lacking. And so that's where there are opportunities for companies, for the data that we bring to really enable companies to get differentiation.
So we've heard asset side of the balance sheet, we've heard communities, we've heard social networks. Catherine, can you tell us a little bit more on the, I guess, the fingerprint underwriting and some of the data that you can collect from small businesses?
So we started with eBay, but we've added a bunch of other data sources that seem like they would not necessarily be worthwhile. And I'll start with social data because it seems like such a flash in the pan. We added Facebook and Twitter. Our customers basically build profiles. When they log in, they pick a primary data source, and then we'll ask for secondary and tertiary data sources to build a profile that includes identity as well as business performance. And so we started with eBay and other marketplaces like Amazon and things like Shopify and Yahoo and Etsy. And now we've added things like UPS and QuickBooks. But to get back to social, we added that to see sort of what would happen. We really didn't know. And we learned that our customers use Facebook and Twitter as basically a free CRM platform. They are communicating offers, and they are resolving disputes and complaints, and generally, marketing information and product information about what they do. So our customers who are actively using Facebook and Twitter to communicate with their customers are 20% less likely to be delinquent than those who aren't. And it's not about the data specifically, it's about their level of activity. So we didn't really know what we were going to find out. What we found out is that it was really important, and now it's on to figuring out why. But I think what's really exciting about all the alternative data, I'll talk about UPS, for example. We're going to launch in the next couple of weeks the ability to make a decision about a customer based solely on UPS data. And that sounds kind of crazy, but we've been able to look at UPS data against our customers' performance over time, and we've learned that we know some things, whether it's the quantity of shipping or the size of the box or the consistency of the package or where they're shipping it to and the disparity of zip codes to which they're shipping. All of this data builds a profile, and we understand the risk of that because we have customers who've added it over time. So again, it's more about where do businesses interact with data, whether it's merchant processing, whether it's online advertising, or whether it's their checking account or any other QuickBooks, any other place they interact with their business. If you can get that data and you can build a picture, then you can make a unique decision about that customer, and that's the fingerprint piece, because everybody's data looks different. When you talk about credit quality and bureau information, you have a limited number of data points, and it can only tell you so many things. And small business owners have artificially deflated credit quality because they're typically using their personal credit to run their business, and so therefore that data is even less meaningful than it is for consumers. So I think what's super important in general is being able to see the whole picture, as Mark said, sort of a 360-degree view of the customer.
Can you talk a little bit about where the big banks stand in this, and where's the sweet spot for a company like Cabbage? Well,
the sweet spot is any place that any business that a bank doesn't serve today. We were at the SBA and Treasury event last week, and the folks from the SBA said basically any business that's generating $1 million in revenue or less isn't being served by traditional banks. Not because they don't want to; they're not bad guys. They just don't have the ability to create a less expensive underwriting process so they can afford to put out something like $10,000 or $20,000. It costs them too much money to originate that loan. So if you're doing less than $1 million and you need less than $100,000, then you're not served by traditional lenders. And also, if your credit score is below 720, you're not going to be served because they're uncomfortable with that risk profile. So banks aren't serving them because they can't, not because they don't want to. And they're really not going to be able to serve them any differently until they embrace new technology and automate their underwriting platforms to accommodate the kinds of data they should be looking at.
So you've got great data. The companies have given you great data. How could banks use that if they had similar types of? You seem like you have a very advanced underwriting capability. Do you feel like that's something that big banks will eventually adopt, or where does that go?
It's funny. Mark and I were just talking about this earlier. Do you want to answer that question?
Well, sure.
You had a really good response to that earlier.
Well, I think they will due to fear. I think the people in this room are identifying that there are low-risk borrowers that can be underwritten in using technology, and they'll cherry-pick the best risks, and the worst risks get left to the banks. I think the idea that there's this one-dimensional score of FICO and people oriented around that is going to be a bit misleading in the future. And what will happen is the default rates will start to go up for the incumbent banks, and they'll absolutely be able to take advantage of this capability. And we have banks as clients, and a lot of banks we engage with here in the States as well as overseas are very conscious of these capabilities. They're starting to invest in pursuing them, and I think they'll have to, because if they don't, then the best subset of customers are going to disappear and move on to the cabbages of the world.
And we don't want to compete with those banks. I said that before. We believe that platforms like ours and a lot of other folks out there in our space will eventually enable banks to serve these customers if as Mark said, they don't get into it too late.
And Mike, you're also serving the big banks, but from a credit bureau perspective. So when you view some of the stuff that Jeff and Mark are doing on the social side, how does that fit into a credit bureau perspective, and how would your clients ever be able to use that? Does L2C think about that in terms of a data source that could ultimately be provided to the banks?
Sure. So I will say that the banks, Mark's right on, none of them just use FICO. Okay, I mean, if anybody in here thinks that, they're wrong. There are no big banks that just use FICO. They're either using fraud data, some other public record data, solution like ours, one of our competitors, but they don't just use, or a custom score of their own. Nobody really uses FICO except maybe on the back end to securitize the portfolio. They don't use it for underwriting. However, there are benefits of FICO. It's a normalized score, so it's a baseline, right? I mean, that really helped automate and drive the growth of the industry. And I think we have to be a little bit careful as we think about secondary markets, because there will always have to be some sort of normalization, standardization, because there's got to be some sort of common language that we speak on the back end. In terms of social data, we think it's tremendously valuable. We had a client symposium in early 2011 and early 2012 and had done some work with LinkedIn and showed some really predictive things based off LinkedIn profiles on consumers, and think it can be truly very valuable for those that are new to the country. GE stood up and said, I couldn't talk to my lawyer about that for 3 years. So, the challenge is the regulatory environment that we're in right now. I think in terms of the banks where they could use this thing being social data, I think from a marketing perspective or a CRM perspective, obviously, from a fraud perspective, there seems to be a little bit more leniency from a compliance and regulatory viewpoint. I just think it's going to be a challenge to use it from an underwriting perspective, because as soon as it gets to where they can use it, I fear by the time it gets to that point, it'll be gameable, because everybody will have figured out, oh, the banks are using it, so I'm going to go create all these different. And so then you're going to really have to be advanced in having the ability to match online and offline profiles and see where there are variances. But I just think in the short term, it's going to be tricky for banks to use it in an underwriting environment. I think from a marketing perspective, it has a lot of application, and we know it's very, very valuable.
Just quickly on that gameable question, that's an important issue. We found that there is, in some emerging markets, some risk of this, and as a result, we found that scanning across the breadth of online and offline profiles and cross-referencing versus the internal client data, that's key. So finding the consistency of profiles. Yes, sure, I can create a fake Facebook account, but can I create 50 fake accounts internally, externally, online and offline that are all consistent with each other? No. And that's back to some of the fraud applications that you touched on.
And it's not that different than what exists today. There are frag files at the credit bureau. A lot of frag files, that means fragmented files. Traditionally what that would be is somebody's named Richard, they go by Dick, they go by Rich, they go by Richard. Whatever his last name is, he has 3 different files at the credit bureau. That could be a real case, but it could also be a case of somebody just trying different names to get some piece of data to come back to them, and that creates a lot of files at the credit bureau. So it's not that dissimilar from what you have today. It just, when you say social, it scares people, but that happens today. I mean, a lot of the transactions we get that are new to credit really are not real transactions. They're synthetic fraud, and you have to sift through those to find the ones that are truly people.
So if I'm hearing you correctly, the banks are buying data through you as a credit bureau, and you as a credit bureau are highly regulated, and through that regulation you cannot provide some of the social data that may actually be valuable at this point in time.
We could provide it. So we are regulated as a credit reporting agency. That doesn't stop us from buying and delivering social data, but our clientele and our distribution channels are traditionally the Equifaxes, the TransUnions of the world, so the big credit bureaus, so they sell into the larger financial service organizations. The challenge is when they try to use that, they being the larger financial service organizations, they go through what's called a model governance process. That's where you run into troubles, and so we can't monetize it. So that's where it becomes problematic for us. We don't have a path to scalable monetization for it right now.
Do you have something there?
Yeah, I don't see how the innovation comes out of the U.S. I was meeting with a Fortune 100 finance executive this week, and he said he ignores IP address, which costs him $50 million a year because he just doesn't want to deal with the regulation of it. Abroad, it's a totally different perspective. They're saying, wow, you can give credit to people here? No one's getting credit and you're extending it? Thank you for improving their lives. How can we help you? Here it's, wait, you're doing it differently? Wait, maybe you're excluding some people. We need to put, slow down. So it's just a completely different mindset, and I think the innovation is going to happen out on the internet abroad and then come here. I mean, Citibank had this much computing power in 1995. There's 1 million of these being activated every day in the emerging markets right now. And this, a phone like this, and probably eventually this phone, generates a ton of data. Every time it goes somewhere, it connects to somebody. Anytime a transaction passes through that can be used to manage risk and empower the owner of the phone to get better access to credit. So I just don't see it happening here. I don't see how we could innovate fast enough.
And what markets are you participating in right now?
We're currently in the Philippines, Mexico, and Colombia. We're getting ready for Indonesia and Brazil.
Okay. Tell the audience a little bit more about the average profile of a customer of yours, because a lot of times when you think emerging markets, you automatically gravitate towards a Kiva or a Grameen Bank and but someone in a hut buying a goat, right? And that's not what you're talking about at all. So expand a little bit about the category you're talking about.
Yeah, we're really talking about the class that is creating most of the wealth on the planet right now. So think of the U.S. in 1955. The baby boomers. They were underbanked. This is what's happening in Mexico. There's 400,000 engineers are going to graduate from 4-year colleges in the next 4 years in Mexico. That's going to completely change the economy. The unemployment rate in Manila, in the Philippines where we're live, for English speakers who can work in a call center is 0%. You can literally walk out, quit in the morning, and be employed the next day. Their wages are going up 20, 30% a year. Call center workers, people processing your when you call for a Dell, you want customer service. Architects, these are white collar, highly employed, plugged into the global economy, middle class, educated people that are just underbanked because banks don't know how to deal with them.
And what is their, first of all, what is their status in their family and in their community?
Well, good example would be a customer who's say, 27 years old. They make $400, $500 a month. They make 8 times what their parents make. It's equivalent of like, wow, you've got a job at Goldman Sachs. Wow, you're working at an international company. You're the middle class, and it's very respected, and that's who we're targeting. And I think it's not dissimilar from Lending Club in that they're targeting sort of higher end customers. It's just that in these markets, no one knows how to identify them.
And you talk a lot about that a lot of the innovation in credit underwriting you feel is going to come out of emerging markets where there's less regulation and there's also less kind of established infrastructure. So what will we learn in the United States from what's happening abroad?
Well, I think to understand underwriting, you look at underwriting over a couple hundred years. And basically the way underwriting worked for hundreds of years is someone would talk to you. They either knew you personally or they'd talk to someone in the community. And your reputation was how you got credit. In these markets, and when you lend online and when you engage the social network, that's essentially what you're doing. You're lending against their reputation. And because of social networks, you can now do that with incredible efficiency. So I think what you'll see is lending based more on character and reputation and less on financial assets. Kind of like the way it was at the turn of the century here.
So what if you're a deadbeat?
I think you'll have trouble getting access to credit.
What happens to the rest of the community if you're a deadbeat?
Well, with Lendo and with microfinance, when you don't repay, it affects other people in your community's ability to borrow. So it's not uncommon that someone who's late gets a call from their friend and says, what's going on? You're affecting my credit. We interviewed dozens of microfinance professionals, and they said that 90% of their collection activity is done by people in the community, not them. So we don't have quite that high a ratio because we use a lot of software to do the collection activity. But we engage the community, and when your uncle calls you up and says, what's going on? I'm going to need a loan to help my daughter go to school, and you're screwing it up, the money shows up the next day.
And then talk about the flip side of that. If you're doing really well, what does that do to everyone around you?
Well, I think that's the thing that really excites us is we started with 100 people we knew and trusted in the Philippines, and now we have hundreds of thousands of people we trust. Because that first group, a couple of them took out a loan. They invited people in to help them get that loan, vouch for them essentially. Some of those people wanted a loan. When they repaid, we then felt comfortable lending to the next group. So you've got this sort of network exponential growth, this expanding sort of circle of trust. So with every repayment, there are more and more people who we can now lend to as a result of that.
Great. And Mark, maybe you can jump in here a little bit. I'd love to hear, when you're trying to verify somebody in an emerging market where there's not much data, how many attributes can you typically find, and what type of attributes do you find?
Well, we've processed data now in about 20 countries, and been doing it for 2 or 3 years. And one of the great things about online data, and I'm biased to say this, is that it is remarkably consistent country to country. So you do, with a few exceptions, places like China and others that have unique social networks, generally speaking, the amount and type of data you find is quite different. You can learn different things from that data, but the sources are quite similar, not quite different. We can usually find 200 attributes or so about people, even in places like Indonesia and the Philippines. But with some clients, we can find 200,000 attributes. It depends on how you define big data, and I don't want to get into that just yet. But you can find lots and lots and lots of signals about who someone is. Now, it depends on the use case. If you're trying to verify that they are who they say they are, then the sorts of data that you find are things like, hey, is their name and their email and their location consistent when you look at their IP address and their email address and their address? Those sorts of things really help you build confidence, especially in places that don't have established credit bureau systems. However, most of our customers are here in the US, and it's a similar story here too. Even in the US, which does have a very mature credit system, there's a surprisingly high degree of lift when it comes to that same sort of data. that answer your question?
Yeah, and just to expand a little bit, let's say you're dealing with a small business that has extraordinarily high Yelp ratings and other ratings on their food or whatever it may be. How does that correlate into a credit risk?
Well, I mean, there's been quite a few small business lenders that have looked at that and taken decisions on the back of that, whether it's Yelp or Google or Facebook or Foursquare or Bundle. Businesses that have high ratings are good. Businesses that have high and consistent levels of activity, as Catherine mentioned, are good. Businesses that have consistent levels of activity and then that stops, that's not so good. We tend to be a component within a client's existing credit decision, or within their existing fraud decision or their marketing decision. So we don't sort of necessarily know whether that is by itself exogenously good, but there are definitely positive signals for businesses that have been around online. Some of the most powerful variables are things which are even more prosaic, such as just how long has this business been around? Have they got a website? Was it registered 2 weeks ago or was it registered 2 years ago? Simple things like this. Any one of these things, of course, can be gamed by a small business, but again, back to my earlier comment, when you cast a wide enough net and you bring it together with some of the offline data, then you can start to build up a coherent profile of the applicant.
And I guess this goes out to any or all of you. Talk about some of the attributes that you uncover with your data that give you result in a better credit underwriting decision for either you or your clients. Mike, maybe you want to talk about that.
Sure. Well, I can talk a little bit about ours and then a little bit about what we saw in our brief dip into the social data. So I think level of employment, level of education are obviously important pieces of data. They're big drivers of the income statement or, the capacity of that consumer to pay a bill. I'm sure that's big in what you do. More around the data that we have that's less intuitive maybe is checking account historical performance, subscription historical performance. So for instance, do they discretionarily spend money on things like magazines, book clubs, DVD, wine clubs, those types of things? And do they pay those things back? Obviously utility and cell phones and rental payments. So those things, surprisingly enough, none of that's on the credit bureau. Right? I mean, you would think that would be on the credit bureau. Unfortunately, it's just not today. And so that's the gap we really try to fill. And it results in tremendous new swap-in opportunities for our clients. I mean, they're able to increase their approval rates by 20% while taking their risk rates either slightly down or keeping them level. So, those are some examples of our data.
Is there a new segment that's uncovered from that, or is it pretty much just de-risking the segment they're already covering?
No, absolutely. The new segment are those people that were bureau no scores and bureau no hits before, and then the thin files. I mean, a lot of the time the big banks have a criteria that says you have to be on the file for a certain period of time and have a certain thickness of file to even get considered in their underwriting process. And so that's kind of a hard cut. So those populations come into view with our data.
That's me as a resident foreigner on the panel.
Exactly. That's why you got turned down at Chase.
Yeah, absolutely.
You should have gone to Capital One or somebody like that.
And Chase has my assets. Or at least enough of them to be comfortable with a couple of $1,000. I don't want to pick on Chase per se. There's pretty established processes amongst all of the banks that are quite similar.
Yeah.
But it is this disconnect in the world of again, I don't want to use the word big data. It's such a cliche. But supposedly there's this abundance of data that we're all hearing about, and it seems like every VC pitch starts with a chart that goes up and to the right with respect to the explosion of data. But then 17 steps later, when it comes to the decisions about customers and the optimization around the customer marketing and fraud and credit decisions, they're still reasonably primitive in terms of the number of attributes that are being exploited and used in ways that help customers. So where's the disconnect? There's supply of data, but there's a lack of consumption of data. That's a technology problem. So that's why all of us are sitting up here so excited about this, because there's this wealth of data that helps us understand and trust customers. And now for the first time, there's whole new segments of customers that we can understand and trust. So what's the most effective way to get them the products that they can afford to repay?
And I'd keep the question open. I'd love to hear from Catherine. What variables are you finding most effective that you may be able to share with the audience, and how do you use those?
I think it's easiest to use eBay as an example because you guys all probably shop on eBay and have some ideas about what would be important. And I like to share what we thought versus what actually happened. So when we started with eBay, we thought that what was going to be really important was seller rating and the number of transactions and the total revenue per month that they were generating. And it turned out that really wasn't what was important. What was important is that they were consistently selling the same types of items, and that they had a large number of transactions, and that from a seasonality perspective, they followed the same seasonality curve every year. So you can see, multiple years of data. And the reason that that extrapolates to UPS, which is really fascinating as well, is we discovered that it turns out if you sell the same thing all the time, you're really good at it. It takes a long time if you go to thrift stores and flea markets and you buy stuff and you list it and you sell it. You got to enter the information in, and you got to take a picture and put it up there, and it's not consistent, and it takes a long time to source the items. If you're running a larger, more consistent business, selling more consistent product, you're better at it. You can price it more effectively, and you can list it more quickly. And so with UPS data, if you ship the same size box all the time, you're a better risk than if you don't. If you ship to multiple zip codes all around the country, you're a better risk than if you ship to a certain area all the time. It's stuff that you wouldn't really have expected, and you have to get the data to figure it out. Ultimately, what's most important for a business is longevity, which I think somebody mentioned earlier, may have been you. So, and consistency of business, even if there are seasonal dips, that it's consistent. And certainly revenue consistency, that you're at least seeing growth and you're not seeing a decline. Everything else is kind of gravy, and it helps you optimize for price and line and terms on the transaction itself.
Got it. At this point, I'd like to open it up for questions. Are there any questions out there? Over here. I think we have someone coming up with a microphone.
Follow-up question to the regulatory environment in the US. So it's about making underwriting decisions based on alternative data. So we also we heard from Mike, for example, if I'm a subscriber to the Wine Spectator, it might be a much better risk. What if a consumer voluntarily gives me access, say, to his Mint.com account, to his bank account statement, in how it's happening in Australia? He gives me that information to prove to me, hey, I'm a good risk. What would the regulatory response be? Is this possible today? Because we all said like the data exists and it's underused. So is it possible today, or would the regulators shut this down?
No, the regulators will look favorably on consumer supplied information. So I think that's, a terrific solution to some of our issues. I mean, I think technology will overcome. I don't disagree with Jeff saying that most of the innovation will happen outside the U.S., but I think you also got to see the base that the other countries are coming from, right? I think there will be innovation in the U.S. in things like that. I think technology can open up that consumers that have checking account information available via Yodlee or other platforms can share that with the people they want. And I don't know that it'll turn into a Google, what they tried to do with the health record where you could take it around with you, but I think the consumer will be much more in control of their data in the next 10 years. I mean, if you think about it, do you think the credit bureaus in 10 years look like they look today, or do they look more like a Facebook or something like that? I think consumer supplied information is the key.
Catherine, you use a lot of business supplied information. Tell us, why does a business give you all that information?
Well, to get access to capital, first of all. So they build a profile. They can just give us a couple pieces of data. The more they give us, the more cash they get. So they're very excited to provide that data to us. And from a regulatory perspective, we don't have the same limitations that consumer lenders have. We can use a lot more data. And it is, supplied. I think a big issue with talking about data is who actually owns it. And I mentioned this when we were in Washington, but the challenge is there's lots of folks that have data about you as an individual and about you as a business, and they won't give it to you, even though it would help you prove your case, to build your profile, to get better terms or more access to more capital. Until there is some sort of democratization of data for both consumers and businesses, I think that we're a long way from getting where Mike described.
Yeah, I think you hit on a really important point, the idea of opting in. If you think of a credit bureau works for the lender or for the bank. What we're doing at Lendo is we're empowering individuals to use their own data, which they choose to share, to prove their identity and trustworthiness. And I think that's how the internet works. It's really the customer is empowered because they're always one click away from something else. And I think this idea of being lender-centric with data is not going to hold up the test of time.
Catherine, could you just go into a little more detail on, once you have the company's shipping data, you have their Quicken daily P&L, you have their e-commerce shopping data on a daily real-time basis, you have probably their cell phone and utility usage. You know that company really well, and you continue to collect that data over time. Tell me about what the relationship is like with the business that you collect that data with, and how will that relationship expand and evolve over time?
Today, most everybody is just very grateful that they have access to the capital. So they don't complain about sharing the data. That we get checking account data. We use Yodlee, and so they log in and share all their checking account information with us, in addition to information in a credit report. It's stuff that when we first started the company, potential investors said, no way, there's no way in hell anybody's ever going to give you that data, and it turns out they do. So I think what's exciting about where that can go is if you think about, and this is again for small businesses, but there's not a Mint for small business. There's nothing, a place where a small business can go, or a medium-sized business, and see sort of a dashboard about everything going on in their business. We have the potential and intend to build that so that we can use the data for their own benefit, not just for us to be able to give them access to capital. And that's where we're headed.
Great, great. Other questions? I see one back there.
Jeff, mostly, I wondered how different have you found your scoring models to be across countries?
I'll just repeat the question for the webcast. The question is, for Jeff, how different do you see the scoring models across countries?
So we found they're almost identical, but I will point out that we're only in emerging markets. I think I would suspect that it would be very different if we were to apply the algorithms to, say, Japan, US, or Germany.
Also for Jeff, you chose markets that seem very different. So Indonesia, Philippines, Mexico. Why those markets?
Well,
For the benefit of the webcast, the question is, why did you choose Mexico, Philippines, and what was the third one?
Indonesia.
Indonesia. Why did you choose those three markets that seem different?
one is the rate at which they're creating wealth and growing is faster than the US. The second is there's a more breakthrough value proposition because credit is so much more scarce. But probably critically important is they have a heavier and more advanced use of social networks and mobile. So Bogota, where we're live, has greater use of social networks than New York City. And our target group in the Philippines is a heavier use of social networks than Northern California. So there's a transition to a mobile-first internet that's socially that's social, and we're able to tap into that and really get ahead of it by focusing on those markets.
I'm curious, what type of interest rates do you charge? What do the default rates look like?
So we generally have a rate that's in sort of the bottom quartile of what someone who's our target could get. The main difference being that we actually administer the funds, where a bank or credit issuer of credit in those countries would have you go in, fill out paperwork, wait a couple weeks, and then get denied. So it's competitive rates, anywhere from 2 to 4% a month, and it's the default rates are not in line yet with microfinance, which is generally 1 or 2%, but we see a path where we should be into the single digits as we grow. And most people pay back. Most people are good, and most people pay back, especially when they know that their community is counting on them to pay it back.
Great. It's very. I mean, that's A and B quality lending club loans. Mm-hmm. Other questions? Okay, we have one over here.
You mentioned a couple of times about the variables that you consider for creditworthiness. For businesses, is the nature of the business that they're in or the type of inventory that they're buying or selling, does that play is that a factor in terms of creditworthiness?
It is a factor. We've learned this again over time, and we're only now moving into offline businesses. So we've looked a lot at online businesses, which are of course selling merchandise. If you're selling gift cards or stamps or any sort of cash equivalent, something like that, you're a greater risk than if you're selling electronics or some sort of hard good. But you're a worse risk if you're selling a handmade good, for example. So we're learning this over time. And again, our oldest portfolio is really just 2 years old. So our oldest vintage rather. So we're not really applying all of these learnings yet, but we're definitely seeing them crop up.
Next up.
I was just wondering if you've seen any sort of flip side to this. I mean, it's great when the uncle calls up and tells that niece to pay, but maybe that uncle actually rejects the niece. Have you seen any of those reactions?
Where the uncle...
Well, I mean,
oh,
if there's an encouragement to pay, is there a flip side where they actually sort of, well, you're sort of damaging my credit score. I don't want to be your online friend.
Oh, absolutely. I mean, you don't have to endorse somebody. So the question was, do we see people choosing not to endorse their friends or not to connect to them through Lendo? And the answer is absolutely. And often that data is much more valuable. People who choose not to endorse each other, there's probably a reason behind it, especially when you look at that in aggregate.
We have a question up here.
Yeah, I'm just curious in terms of that dynamic, the notification of people in that community, how you think you would do that.
So the question is on the dynamic and the notification of people in the community on borrowers and activity.
Yeah. So the key is transparency. So it's important that everyone who is getting a loan understands how it can be escalated and who can be informed, and that everyone who can be informed understands that they may be. So a lot of it's about interface and making it very clear, especially when you're dealing with a mobile connection. But what we find is that there's not a lot of, you don't need very much encouragement for social enforcement to be incredibly effective. So for example, I was overheard a call when I was in Manila a couple weeks ago, and they called up and said, "Oh, we're worried about Tommy. We seem to have lost touch with him. Is everything okay? Because he's got that loan." And the person's like, "Oh my gosh, well, that's my son. He will not shame this family. You will get your money." And the money showed up the next day. And we weren't applying any pressure. It was just more of a customer service, and that works. So I don't think that people think like, oh, this is going to be mean. It's actually, you can be by emphasizing what's working and the positive, it builds on itself. People are much more likely to share good news. And as a result, most of our customers were referred by existing customers.
And one more question.
Somebody wants to get a loan, does the future hold you have to be very active socially?
So I don't think so, no, because everything correlates with everything else. People who are providing capital and providing financial services need a threshold to understand the quality of the customer and the desire and ability to repay. And social is one of many data sources that helps establish that. So what we've been talking about here is data in a place where there used to be no data. But social is not the only source of data in these markets. The telcos are thinking very deeply about this space. The governments are establishing very rigorous credit bureaus that are tied to ID systems that are better than the ones in Australia and the US. And all of these things correlate with each other. So I think it's back to this opt-in comment that was earlier. My view is that the future of financial services is choice by the customer. Okay, you would like a product. Prove to me that you are who you say you are and you really understand this product that you're applying for and you have a desire and ability to repay. There are 5 ways to do that. Option 1, option 2, option 3. Social is definitely one of those options.
Great, and with that, I'd like to thank the panelists for coming today.